How you doing, guys? Welcome to another LSPTV podcast. And today I'm going to be addressing something that I was asked in my Discord. Before I get into this, if you are not already part of my Discord, the link is in the description below. Everybody's welcome. But the question was, would really like if you can make a video on proper portfolio creation. And in brackets, the person put free will and whatever works for you, meaning me. But I've been looking on material on properly structuring my portfolio. What's too many projects? What's enough? How to properly distribute funds. Thanks in advance. So I wanted to address this, and actually, this is something that I've been wanting to address for quite some time. But it's not an easy topic, to talk about because it requires a lot of, splits. It goes off into a lot of different directions. You have to have a good understanding of what you're doing, and it's a learning curve. It's not just a question of saying, okay, I'm just going to go and buy a bunch of reflection tokens, or I'm just going to go and buy a bunch of stocks, and that's kind of it. You have to understand, for example, with stocks, there are many, many, many different industries, okay? And you wouldn't, for example, go and put all of your money into one single stock and then expect that to do well, and that's it. Because ultimately, if that goes wrong, then your money's pretty much gone. And that industry that you're in, for example, might be a very poor choice. It might be, an industry that's lacking. It might be an industry that's not doing very well at the moment, and so on. Whereas another particular industry, maybe technology, might be doing very, very well. And then within that technology industry, there may be some smaller companies that are just starting, that are doing, or bringing some new technology, to humanity or the world or so on. That's really going to be a game changer. And you might think, these are the ones, and you take a little bit of a sort of calculated risk. So there's so many variables, right? So we're going to be going through quite a lot today. So I hope, obviously, you enjoy the podcast, and let's get stuck in. So portfolio management requires many skills, right? We've said this. And for example, a good understanding of maths, numbers, but there's two qualities above all that stand out. And that is discipline and being able to cut a loss. This is something, at least, that I've found over the years. You can have all the skills in the world. You can understand macroeconomics. You can understand different trends. You can understand, a whole host of different areas when it comes to, global markets, when it comes to understanding the stocks that you're in, the asset classes that you're trading in, commodities, bonds, cryptocurrency, different areas within cryptocurrency, and so on. But if you don't have discipline and you don't know how to cut a loss, okay, because remember, we're talking about portfolio management, which means we have a portfolio of, and then a list of something that's in that portfolio. It could be 10 cryptocurrencies. It could be, a mixture of maybe 5 cryptocurrencies, 2 stocks, a couple of commodities, and so on, right? So it's a portfolio that you manage over time. And then if something isn't working, you need to be able to say, okay, this section or this part of my portfolio is doing pretty well, but these 2 or 3 are performing quite poorly. So I'm going to cut my losses, and I'm going to allocate those funds into something that I feel, is doing well. Now, obviously, that sounds easy, but there's a lot to take into consideration, because you have to allow these things time to unfold. And this is something that is absolutely key, because many people will jump into something, and when they start to create a portfolio, the question is, what are you creating the portfolio for? And then once that portfolio starts to build and grow and so on, if you say, and you don't have the discipline or the emotional control to allow your portfolio to grow over time, and you're getting in and out of things every month or every week or every 2 weeks, your portfolio is going to, not grow. Your portfolio is going to, probably suffer greatly. And then obviously you have to take into consideration fees. There's so much to take into consideration, right? So let's start with the question, how much is enough, right? When you're thinking about portfolio creation, so you say to yourself, right, I want to build a portfolio that is going to produce either an income or growth over time, right? Because ultimately, when you're investing in something, the whole point is to, make money at the end of it. And obviously you want your money to grow, right? But the question is, how do you want your money to grow? Are you investing because you're looking for a return on your investment over time? Or are you investing because you're looking for growth, only? So for example, you want to put 10 grand into something and then just allow that to grow for a couple of years, maybe into 20,000 or 30,000, and take your money out, which by the way is an insane percentage increase. But anyway, these are just basic numbers. Or are you investing because you're looking for an income, or are you trying to do both? I mean, portfolio management and portfolio creation to start with, and then portfolio management requires, a lot of thought and a lot of time. It's not enough to just say, okay, because remember, a lot of people that are listening to my voice right now are in the cryptocurrency space, but mainly in the reflection token space, and they're in a box. So they just think, if I purchase 5 or 6 or 10 different reflection tokens, and all of those reflections will come in and I'll just make, plenty of money every day and I can live a cushy life. That's not the way the world works, unfortunately. If that was the case, then we would all be doing the same thing. And this would reflect in the charts of the reflection tokens themselves. This would reflect in the business of the reflection tokens, themselves. And we would see this. We would see this being reflected in the cryptocurrency space. That's not the case. Because a lot of people in the cryptocurrency space are not interested in portfolio management. They're not interested in creating a portfolio. They're interested in making quick money, 10x, 20x out. Look for the next one, 10x, 20x out. Now, maybe they use that money to then put into something that is a bit more sustainable, perhaps something on the stock market, maybe putting their money into physical gold and so on. But in the cryptocurrency space itself, the general consensus and the sentiment is, if I can get into something and 10x my money, I can move on to something else, right? So there has to be a kind of investor mindset shift, right? But going back to portfolio management, how much is enough? You will only ever have a finite amount of money at your disposal, right? We can increase this by working harder, maybe doing multiple jobs. Some people have more, some people have less, but it's irrelevant. You personally will have whatever you have, and you need to make that work for you, right? So we have to start to think about, diminishing returns, diminishing profits. These are very important because there will come a moment in every portfolio creation, right, where the management of that portfolio will get to a point of diminishing returns, meaning anything else that you add to it will just have a negative impact on that portfolio. Okay, so there is a balance. There will always be a balance with portfolio creation, and then the management of that portfolio requires discipline and everything else that I've discussed previously. Okay, so let's look at some things. Firstly, we need to be able to research. Okay, it's not just a question of saying this industry or this asset class produces, we use reflection tokens as an example, produces reflections. So I'm just going to go and dump all of my money into multiple reflection tokens, and that's pretty much it. That isn't a plan, because there's no research that really goes into that. That's more of, it's a reflection token, it gives reflections, so I'm just going to, buy on that premise. But when you start to look at what you're trying to accomplish, which is where all of this starts, I personally, myself, I'm looking to do both. I'm looking for my portfolio to grow over time. Okay, so on a yearly basis, I want to look at my portfolio and say, okay, I started at the beginning of the year with $1,000, and at the end of the year, I'm now currently sitting on $1,200. I'm happy with that. It means my portfolio has grown. Then I start to look at the income side. My income I was making, and again, we're using reflection tokens as the example. You could use dividends with stocks and so on. There's many, many examples, right? But we use reflection tokens. I started with $2 a day, and by the end of the year, I'm currently making $15 a day. This is good because I'm increasing, my portfolio is increasing both in value and both in the reflections that I'm getting through that portfolio, okay? So there's appreciation, and there's also appreciation of my reflections. So appreciation of growth, appreciation of reflections. So we have to have a focus. Why are we looking to create a portfolio in the first place, right? It may seem like a simple question to ask, but it's not always easy to answer. Because when we really delve a little bit deeper into that question, we start to realize that what we think we actually want is not what we really want, and if we're honest with ourselves, really honest with ourselves, the general answer will be, well, I actually just want to make a lot of money. Okay. So being able to pull yourself away from that and start to understand that portfolio creation requires much more thought, and a much more deeper understanding of what's going on in any asset class, a broader understanding of the markets. And then there's a lot of research and time that has to go into this. And then obviously the management of your portfolio, again, requires a lot of time and effort, right? Doesn't mean you have to be watching your phone every day or your portfolio every single day. But it does mean that you have to be able to manage and then act according to what your portfolio is telling you, according to your set of rules and your investment plans and so on. So you have to treat it as a business. It's not a hobby. Okay. This is very important as well. We're not here to paint pictures. Okay. We're not here to draw anime. We're not here to teach people how to, make colorful toys from egg boxes. We're here to invest, and we have to treat it as a business. When you treat it as a business and you take it seriously, it forces you to start to think like a business owner. Okay, we hear this all the time, and it's quite incredible because for the last 26 plus years, this was something that I heard from the beginning. Treat it like a business, and it's something that I still hear now. Which means if I'm still hearing you have to treat your trading and investing like a business, it means that nothing's changed. People still have this fallacy and this idea and this mindset of just, I'm going to make quick money, and that kind of investor mindset isn't really an investor mindset. It's just a very poor gambler's mentality, right? Now, once we've decided that we're going to really take our portfolio creation seriously, we're doing our research, we're looking at a lot of different aspects and areas, and this is just a general overview video, obviously, right? We have to start to think about how we're going to manage this portfolio. So let's say we've bought into 2 reflection tokens, 1 stock, we bought some gold, let's say PAX gold, because we don't have to physically hold the gold, so we just buy the PAX token, which gives us a portion of that gold, depending on, let's say we bought 1 full PAX token, okay, which means it's 1 ounce of gold, right? And then let's say we've bought some platinum, okay, whatever. So we're holding 5 assets within our portfolio. Now we have to start thinking about managing that portfolio, right? So do we use fancy software? Do we need fancy software? Do we need to be able to look at every single metric, okay, and overcomplicate this? Or will a simple spreadsheet do? I personally have been doing this for a very long time, and I find that keeping things very simple and just tracking things either within the app itself that you're using, because remember, obviously, when you're, and I'll just quickly say this as well, when you're using, or engaging in decentralized finance, let's say, for example, through Trust Wallet, you have to learn to be able to go to BSC scan or Etherscan or, so on, and get the information and then put that information in a way where it is, easily digestible and makes sense, right? Most people don't want to do that. So being able to track your results, being able to take everything into consideration. I bought on this date. This is how much I bought. This was the cost. These were the fees. This is the gas fee. This is everything, right? That goes into the spreadsheet. And once you've created a simple, effective spreadsheet, doesn't have to be insane, then you can basically just add or subtract what's in there. Here's my 5 assets. This is what I bought them for. These were the ads that I did. These were the allocations that I have. This is the percentage return, so on and so on and so on. Okay. And this helps you to engage with your portfolio as well. Now, having fancy software or having some software, to do portfolio management isn't a bad thing. I personally prefer to be more engaged with my portfolio though, and doing it, say, for example, with a simple spreadsheet or even writing things down, with a pen and paper, which is something that I've always found more beneficial than using software because it sticks more, helps you to, or forces you to engage with your portfolio in a way that you would never do with software. Software makes people lazy, okay? And then you're talking about managing your funds. Now, this is really important because this is where portfolio creation can be very, very tricky. If you start with $1,000, in January, and then you split that $1,000 into 5 chunks and say, I'm going to use $200 for each of my portfolio allocations, right? So I've got 5 assets. Here we go, $200, $200, $200, $200, and $200. Then you have to start managing your assets. So you will monitor those, say, on a monthly basis or on a fortnightly basis, and you'll keep a track of these because obviously some things move quite quickly. We get different cyclical cycles, we get mini cycles, we get obviously macro cycles. Depending on what time of year it is, we have seasonal tendencies and so on. So all of these things we take into consideration. We monitor our portfolio, and when we see that one is doing well, do we want to add to that position? Now, do we add to that position by removing something that isn't doing well and then put that into something that is doing well? Do we allow the ones that aren't doing so well to maybe gain some traction because they may turn? Do we add to those losing positions? Do we add to the winning positions? Do those funds come from outside of our portfolio? Or do those funds come from within the portfolio itself? Is that total allocation the only allocation that we have? Or have we set funds aside or a portion of our income or a portion of our savings to go into the portfolio at a designated time throughout the year, and so on and so on and so on? A lot of variables. And I've only been talking for maybe 10, 15 minutes. So you can imagine how long, and how much thought and time and effort has to go into portfolio creation, right? So it's not just a quick cut and shut, right? Now, what percentage of your portfolio, or your funds are you going to allocate within your portfolio to each of the assets that you are allocating funds to? Do you put more into reflection tokens, for example? Do you put more into your stocks? Do you put more into your commodities? You have to understand risk on and risk off. You have to understand, cyclical cycles. Like I said, you have to understand that when the market, for example, is in a downturn, and being able to recognize that you need to start shifting your portfolio around to take money risk off and put it, into places where it is safe, store of value, allow things to, unfold. For example, right now we are going through increased inflation. This is a problem. And with increased inflation, people are starting to think about pulling their money from the stock market and putting it into safer havens, for example, like gold, and other places where they know that their money is going to not decrease in value at an incredibly fast pace. So, for example, if somebody has $100,000 stuck in the stock market in, say, 5 different stocks, and that's kind of doing okay, but then they start to see that it's 95,000, now it's down to 90,000, maybe it's 85,000. That's not a good thing. And obviously they may be looking at that and thinking, do you know what? I can see that the market's turning. Everybody's telling me, the people that I've trusted with my portfolio, because obviously portfolio management can be allocated outside of yourself. You can actually pay somebody to manage your portfolio, which I don't recommend unless they're really good at what they're doing. It's always best to learn to do this yourself, obviously. But anyway, I digress. And they may feel that removing that $85,000 out of the stock market, for example, and putting it into maybe $50,000 into gold, and maybe the remaining $35,000 into another safe haven, that is holding its value well, may help them to weather the storm, over the coming years, to then be able to put that money back to good use when things start to pick up again. So as the market's declining, things are getting quite bad, and then you have a flash sale effectively where, say, the stock market takes a bit of a downturn and things are pretty bad. A lot of stocks are, taking a pounding. The cryptocurrency market is taking a pounding, and so on, and that $85,000, okay, which would or could have been maybe 50,000, you could have lost half of your portfolio or maybe even less, is still 85,000. So you've taken a $15,000 hit on your portfolio, okay, removed the risk by taking your money out of the stock market, waited for an opportune time to then put that $85,000 back into the stock market at sale prices to start picking up stocks at effectively rock bottom prices. Okay, and then that $85,000 will go way, way further than it ever would, if you'd have left it in there to basically get decimated by a stock market that's going down. The question is, not the question, but the most important thing is, though, you need to be able to recognize that this is happening, which goes back to portfolio creation requires being able to understand the markets, being able to understand macroeconomics, being able to understand all of these things that are happening around you, tons and tons and tons of research, being able to stay close to people who understand what's going on, make sure, that the information that you're receiving is from trustworthy sources. I know this may, can sometimes feel a little bit daunting because it's like, well, where do I go? What do I do? The very fact that this person is asking me, number one, fills me with humility, because I don't know everything, and I'm trying my best to kind of give the information that I feel, is pertinent and, and can be used in a non-financial way to kind of spur investors on to really think about some of the things that they're doing. But the very fact that they're asking me to do this video, is not a bad thing, because I feel that the people in my Discord and the people that reach out to me, trust what I'm saying. So there are trusted sources out there. There's a lot of people out there, that are very good at what they do, and very good with the information that they give. And ultimately, don't put yourself in a box and say, well, this is impossible and there's nobody out there that's willing to help. I'm willing to help. I'm always willing to help. Okay. So going back to what we were saying, you have to understand what percentages you want to put where, and then you have to manage your risk, which is super important. You have to be able to cut a loss. This is not working, I'm out, done. How do we do this and remove emotion in the process? You say, if this $200 that I'm putting into this asset, okay, of the $1,000 that I'm allocating to my portfolio and that I'm going to be using for my portfolio creation, this portion, this $200, I've put into that asset. If that $200 becomes $150, I'm pulling it out of that asset. I don't even care whether I miss an opportunity. I don't care if it turns, nothing. I'm pulling it out. And then I'm going to wait, I'm going to reassess, and I'm going to look for an opportunity to take that asset out of my portfolio and introduce an asset that is either doing better or has the opportunity to do better. Yeah. Removing emotion out of your portfolio is one of the key elements, okay, of having a healthy portfolio. You cannot allow emotions in investing, okay, to skew your thinking, to make the investment decisions for you. And sometimes people, because they have very little emotional control, okay, they need either somebody else to do this for them, or they have to find a way to put a line there that says, if this happens, then I'm out. Okay. And then discipline kicks in, because you've got to be able to pull the trigger. Right. So, how much for each allocation? Again, this is down to the person. This is down to, the assets that you feel are doing well. Again, it's down to an understanding of everything, right? I said earlier that most people are in a box because they just think reflection tokens are the only thing that exist in this world, and it simply isn't the case, right? So you have to look at the broader market, and try to understand what it is that you're doing. Try to understand what's going on in the broader market, which different asset classes are doing well, which ones aren't doing so well. Read news, read articles, get a feel for what the general market sentiment is, and then be able to allocate your funds in places that are doing well. Okay. And then again, people may say, well, how do I do that? Which places are doing well? Well, that's another 20 to 30, maybe 40 videos, right? So it's about time. It's about starting somewhere and saying, I'm going to start small. I'm going to start to build my portfolio. And ultimately, unless you pull the trigger on something, you're never going to be in a position where your portfolio starts. Okay. You have to do it carefully. You have to start with funds that you absolutely are prepared to just lose. Yeah. If you invest and you say, I'm going to start with a couple of $100, a couple of £100, and that's for me, I don't care if I lose it. It doesn't matter, because my goal is to create a portfolio that's going to be growing over time. And then there's and look, this is something that, goes on forever, right? There is a massive, massive element of psychology that comes into play, because just that last couple of sentences that I said has basically just caused an explosion in my head, right, of thoughts that I needed to express, and I simply cannot. Meaning, While all of this is going on with your portfolio creation, right? So you may get into something, it starts to do well. You think, okay, I'm a genius, and then that starts to um, trigger some responses. Take half of it, put it into something else. So you do that. That something else you put it into goes to shit. Now you're panicking because you're thinking, why didn't I just leave it in there? And then that one thing that you were in that was doing well is also starting to do poorly now. So that's going down. Now you panic. Now you pull it out. Now you've only got $70 left. And I haven't even started with psychology. That was a very, very, very basic example. Okay. So you can imagine, bang. There's so many different variables that you've got to take into consideration. This is not just a cut and shut. Start a portfolio, do well. There's everything else in between as well. So, things that we absolutely need to take into consideration. But it's a journey. It's an investment journey. It's a trading journey. It's something that we have to learn as we go through the processes. And as we're doing this, we're each day looking to improve on the way that we engage with the markets, to make sure that we are doing better and better and better, and putting ourselves on what we feel to be the best place, in terms of our portfolio creation and then our portfolio management. All right. So I hope the video helps as always, and I look forward to speaking to you guys in the next update. Hope everyone's having an absolutely fantastic day or evening wherever you are, and I'll speak to you soon. Ciao for now.